Hello. I was going to say hello in Polish, but I totally forgot how to say it. So, but I do know how to say Yak Shamash. Welcome to everybody. It's the Thursday evening or daytime wherever you are. Live stream, financial thing. Been away for a little while, as you may have noticed, but thank you for coming back to Planet Financial Thing. Let me just adjust that a little bit. So yes, it's been an interesting transition, as you probably know, when you take a trip and then you're away for a while and you return. Everything feels discombobulated. Your hair, where you put things, your just daily routine. But I'm back, so I had a really good trip. Of course, went over to the homeland, the UK. Landed in London. I streamed. If you saw it, I streamed 3 weeks ago this Thursday before I left, and then got on a plane, landed in London. A very hot Gatwick airport at 10 a.m. the next morning. Got straight on the train into central London, and then don't know what the dog's doing. She's crumpling paper, but got on the train, went into central London, dropped the bags off, got on another train, went out to Gravesend, saw the Cufflink team, which I have recorded a video, and I'll be posting that soon enough. Sort of got the skinny on what they're up to over there. It was an interesting visit, a really good visit. And yeah, from there, hopped on the train back to London, spent the night in London, had a wedding the next day in the Grove Hotel near Watford, and then headed down to Poole in Dorset, where I spent a few days, then got on a plane in Bournemouth, straight to Krakow, Poland, spent a few days there, went to Warsaw, Poland, spent a few days there, conquered Warsaw, back on the plane to Manchester next day, up to Loch Lomond in Scotland, and spent a couple of days there. Then back to the U.S., and that was all within 3 weeks. So it was a action-packed, action-packed journey. And I got to tell you, it's funny. Poland and Scotland were not two places I ever really wanted to go. They were never on the bucket list of places to see in the world. And I had all these judgments about what Poland was going to be like. And I got to tell you, I was completely just happy. And I had such a wonderful time there. The people are so nice. Warsaw is a beautiful city. Krakow is wonderful. It was just nothing like I pictured what Poland would be. And then on top of that, when I went to Scotland, I haven't been to Scotland since I was a wee young lad. I went over to Edinburgh. I was completely blown away at how beautiful a city and how historic and medieval and all the beautiful things there are to do there. That I definitely learned a lesson about just not judging places and having these preconceived notions of the way that I think they're going to be. And it was a really, really great trip. Just a little bit of housekeeping. So next week, the stream is going to be on a Wednesday, because on Thursday, I have to have a little surgical operation that I've been putting off for a while, and finally it's time to do it. So next Wednesday, I'll be streaming instead of Thursday, so put that on your calendars. Also on July 27th, we will be having Unbolted here live on the stream. Ashwin and Chris Brown from Unbolted will both be here, I believe, on the 27th of July. Put that on your calendars. I also did have plans to meet up with Plend and LoanPad, Louis over there, but I just couldn't fit it in. I was only in London literally for a day and a night, and it just didn't work. So plan is to get Louis from LoanPad back on the stream, since we didn't get to really have a catch-up in London. Yeah, so that was it in a nutshell, and everything went really well. We're going to be talking about a lot of stuff tonight, catching up, peer-to-peer lending news. We're going to look at some of the interest rate increases that we've seen come down the pipe since the Bank of England has risen their interest rates, and a little bit of talk about where the interest rate is going to go from here. We're going to look at the Trading 212 portfolio that finally had a bit of a home run in the portfolio, so I'm going to tell you about that. What else are we going to look at? Just, general P2P news. We're going to look at some Cufflink things. Speaking of Cufflink, as you know, they are a kind... Where's the dog? Oh, she's right here next to me. She usually sits in her bed, but for some reason, she decided not to do that today. But yes, what was I talking about? Cufflink. Yeah, speaking of Cufflink, generous sponsors of the stream. They've always been very good to Financial Thing and the channel. Really supported this very, very small operation. And I just really like what they're doing over there. As far as I can tell, everything looks like it's heading in the right direction. So please, if you have not checked out Cufflink and you want to support them as a sponsor of the Financial Thing movement, please feel free to do that. You can get up to 9.73% gross interest per annum. They've lent well over $250 million now in property-backed UK investments since 2016, and no investors have lost money. Don't forget your capital is at risk, and please don't invest unless you're prepared to lose money, because we all know that there are inherent risks with peer-to-peer lending. As with any investment, nothing is guaranteed. But you can sign up. There is a link in the description below, or go to join.cufflink.com/financial-thing. That was a real mouthful. Is she in the bed now? There we go. There's Harley for anybody that missed. Oh, great. Look at that. Perfect timing, right? Live. What can you say? This is live, so there you go. Anyway, quick hello to everybody who is here, all the fans. And by the way, thank you to everybody who's a Patreon subscriber. There's been some subscribers now who have been there for probably close to a year, so I really appreciate your support. It's super cool that you've signed up and supported the channel and myself like that. So Jeff is here, of course, Patty, Mark Mason is here, Colin Perry in the Peak District, David Dawson from Staffordshire. Hi, Dave. J.M. Roberts from Toronto, Canada representing. We have Aki Chap in Accrington, the nicest place in the world. Mike Powell is here, I'm presuming in the pub, live in Southampton somewhere. Peter Vince, of course, from Leatherhead. Robert Pates from Hornchurch. John Day is here. Paul Ward from West Palm Beach, Florida. I'm sure, Paul, you are probably enjoying the heat. It's very hot here in Florida. It's been in the mid-30s. Crazy hot. But anyway. And Stephen Hale from Nottingham. Yes, Mike, we will talk about the update that came through from Cufflink today about minimum investments too. That is on the list. So let's get right into the news. Let me zoom in a little bit here. Hang on, just give me a second. Bling, bling. Hopefully you can see that right. Lendy administrators are pursuing almost £60 million of loans where they expect further recoveries more than 4 years after the peer-to-peer property lending platform collapsed. So let's put that in perspective. 4 years. This has been going on, the administration now, for 4 years. I fully expect this to go on for probably another 4 years, so we'll be at 8. So 4 years times 365 days. I can't do that math in my head, but it's a lot of days that this has been going on for. If you haven't checked your Lendy account, by the way, go in there and do that, because you may have a few pennies sitting in there. A 6-month update from RSM, that is the administrator report. There are currently 12 live development financing loans with an outstanding value of $47.8 million as of May 23rd in 2023. And there are also 19 live property bridging loans, aka PBLs, with an outstanding value of $10.6 million, all of which have formal insolvency proceedings against them. That's never a good thing. RSN's update showed $34.6 million was realized from Lendy's development finance loans during the first 42 months of administration, with $16 million distributed to investors. This is going to be an ongoing thing. It's kind of a mess. We all know, right? Beating that horse to death. Unfortunate situation, but it is what it is. And I did kind of run over the numbers that were here inside of the administration update, one thing that always stands out to me is just how much in fees are racked up from the administrator, and this update was no different. Several £100,000. I don't know what the exact number was, but this is a cumulative amount of total time cost from the administrators at £5.3 million total. So RSM certainly has their work cut out for them, but has made themselves a very nice amount of fee base from 2019 to 2023. So just over probably 4.3 million pounds, sorry, 1.3 million pounds each year in fees. Another thing that I wanted to just talk about is I could have been hammering for several years about second charge loans, and I'm not saying every peer-to-peer company has bad second charge loans, but the inherent risks that do come along with second charge loans, especially in recovery. Lendy has a couple on their books that you can see here, PBL 201, second charge loan, and here, no recovery anticipated. And then also, right here, number 9, which is PBL 166, also a second charge loan. See, £885,000 outstanding with no recovery anticipated. So just keep in mind, when you're going after these second charge loans that maybe offer a little bit of a bump in interest, that you do take inherent risks with second charge lending. If something does go wrong with the loan or with the company, worst case scenario, we just hate to see that happen, but it has in the past. I don't foresee that we're going to see too many more company failures now at this point, but you never know. All it takes is one good financial system meltdown. Who knows what could happen? But just be careful with the second charge lending, because you are obviously in second position, and you are going to take extra risk with that, and should the loans not work out, you're probably not going to get your money back. Not in all cases, but I'm just throwing that out there. So be very careful. As you can see with these second charge loans, no recovery anticipated. It's blocked by my head, but trust me, it's there. Okay, continuing on. We've had a bunch of increased interest rates that have happened since the Bank of England increased by 0.5% to, I think, a 5% base rate now. Just Us is one of them. They are now offering up to 10.98% for those who have an adventurous nature, and in them you can get up to 10.98%. Only 1.2% access. I'm not really sure why anybody would even consider that. Just, you can get pretty much 4% now in a regular access savings account in the UK. 5.32% prudent, 8.13% balance. Just Us is not really a big lending company as far as peer-to-peer goes. They've only got 6.9 million in current live loans, but they did bump their interest rates, I think, by about 0.5%. Also here we had a letter from Unbolted on the 29th of June while I was away, an email letter, not a letter. But they have now bumped their interest rates from 0.75% to 0.85% per year, which is about 10.2% annually. That will apply to any loan that was written from the 29th of June forward. So loans that were older than June 29th will not get these interest rate bumps. But this is something that we're going to talk about with Unbolted coming up on July 27th, because they are considering also looking at increasing their interest rates to investors even further than that, which I personally believe, Unbolted is doing a good job. They're sort of slow and steady, right? They just continue along with what they know. However, I would like to see those rates in the 11% range, possibly 12%. I think that would be a good deal for investors. For the nature of what type of lending they do. It's not the safest, even though Unbolted has really, really excellent results in their recoveries and what they do. They're always able to get rid of their gold loans, things like that on the auction market. Excuse me just one sec. But I would love to see, and Unbolted, if you're watching this, let's get those rates up to 11, 12%. I think that'll make a lot of people happy. And I think you have enough spread there to do it between what you receive from your borrowers and what you can pay your interest to investors. But they have increased a little bit up to 0.85% per month. Then we also see Cufflink, which is also offering a rate boost on extended loans. So this is something that I actually talked to Cufflink about when I was visiting their offices in Gravesend a couple of weeks ago, and they mentioned that obviously with the nature of their business being development and finance loans, that things do get extended a lot. And I think sometimes investors get a little bit annoyed to see that loans don't get closed out maybe as quickly as they should, but this is just the nature of what Cufflink does and the types of loans that they write. Development financing, bridging loans, and things like that in real estate, nearly all the time they get delayed. They always overrun, always. You can pretty much factor in, I think, a 20% overrun in time, so minimum. So if you're looking at a 12-month loan, tends to be that it's going to go for another 2 to 3 or 4 months after that. But I think Cufflink wants to go ahead and reward investors with these loans that are getting extended out. So they're going to be offering interest rate boosts. Honestly, I don't know what that interest rate boost is because I didn't ask for specifics on exactly what that means, but I will find out. We'll probably talk about it next week. But it says effective immediately. This was on June 9th, so this happened the day after I left. All investors will receive higher rates on any loans where the borrower rate has also been increased. This typically happens when a loan has been extended or where default interest is being charged. So if anybody in the chat knows exactly what these interest rate increases are, if it's a 1 or 2% bump, a 0.5%, I don't know. Maybe one of you knows out there, but I think that's a good step in the right direction to sort of address these loans that do overrun. And today we got an email too from Cufflink, quite good timing, that they are changing some of their investment policies and procedures starting from the 10th of July, so 4 days from now. They're going to have a new minimum investment requirement from the 10th of July. So you are going to have to invest a minimum of £1,000 for your initial investment. So before, you could put in a lot less than that. So yeah, if you want to try out Cufflink, you want to get in there before July 10th, because then you are going to have to put in that minimum of 1,000. Right now, you don't have to do that. I think you could throw in 25 or 50 minimum for your first investment, but you're going to have to put in 1,000 minimum, okay, from July 10th. Also, it's saying here, as part of these new changes, users will no longer have the option to make their first investment on the secondary market. Once you've completed your initial investment successfully, you'll then gain access to the marketplace and be able to explore a wider range of investment opportunities, including the secondary market. In the event that you make your first investment using a reserve deal, that's basically one that's not live yet, and then you decide to withdraw from the investment before funding is complete, please note that your investor status will reset. That means, again, you'll be subjected to the initial £1,000 minimum investment. What is the reason for these changes? I don't know. I'm just speculating here, but what I think is the reason is, number one, not giving new investors access to the secondary market means that they want those investors who are new to buy loans that are currently available, maybe to make that, those investors speed up to get filled quicker. That would be my best guess. And then after that, they make that first investment, then you can go ahead and buy loans on the secondary market. What also having that £1,000 minimum is going to do is speed up, again, if they have a loan that's not filling as fast as they want, having that injection of capital into those loans on the select that you can pick yourselves will be beneficial for them. Now, does it say we create investment minimum for their investment? So I don't know if that £1,000 is you have to put it all. I don't think it means you got to put it all in one deal. I think it just means you have to invest 1,000. I'm presuming that you'll be able to put that over multiple loans if you want, because I can't imagine they would make you just put it into one. But that doesn't really state here the specifics about it. So I'll try to find out some more information about that and get some clarification on how that works and report back next week. Further interest rate bumps. We are going to see LoanPad here, which is now up to 4.6% daily access, 5.6% for the 60-day access. These numbers are going to go up by, I believe, 0.2% on mid-July. So this will go to 4.8% classic and 5.8% premium, which I currently use the premium. I think that's a pretty good rate for 2-month access account, which you can put up to 250 grand in. Same for the ISA, you'll get exactly the same rates. And LoanPad again continues just to be sort of slow and steady. These rates are getting a little bit close to what you can get in savings accounts now, which we're going to look at those numbers too. But this 5.6 is still about 1.4% more than you're going to get in a bank savings account. Obviously, you have more risk because it's not FSCS protected. However, you do get that higher rate, and LoanPad seems to be doing a really good job. We also have seen Easy Money increase their rates now. The minimum there is 5.03%, which I tell you, that's a pretty attractive rate. Higher than Cufflink, £100 minimum. If you want to get the 6%, you got to put in a minimum of 20,000, where I think LoanPad sort of beats them there for 0.4% less. You can put in a £10 minimum, but you get the 60-day access. So yeah, it just depends on what your pockets, how deep they are. And then you got 7% for 100,000 plus. Again, these are all easy access, which there's no guarantee that you can withdraw your money out, but as long as the conditions are favorable, it means there's enough demand and supply of liquidity within the market. You can take advantage of those pretty high rates. So all of those companies are increasing their rates. Another little bit of Cufflink news, which I thought was pretty cool. Cufflink has now the full B Corp certification, which is an exclusive group of companies that are leading the world in terms of environmental, social, and corporate governance, which is also known as ESG. 196,000 companies across the world have applied for a B Corp status, but the full B Corp certification has been awarded to just 6,658 companies. It's just a 3.4% success rate. Cufflink not only passed the certification test, but it exceeded every parameter set by the B Lab, and they got a score of 90.6. So score of 80 qualifies for the B Corp certification. So another feather in the Cufflink cap, as we'll say. Good for them. LendInvest, yes, I know, not strictly peer-to-peer, but it is a company that I follow. They have announced a £500 million investment to fund part of its future mortgage originations from a partnership with Chetwood Financial Limited, who they have sold a portfolio of mortgages to before for over £200 million. So it looks like LendInvest is just continuing to really grow further and further, as to get a £500 million investment from basically a credit line for future buy-to-let mortgages. That's a pretty big deal. It really does feel like that LendInvest has got really strong footing into the finance market, and as a retail investor, you can still invest through LendInvest, and who knows for how long, right? That will continue to be. We'll see. If they're getting these types of funding lines from institutions, will Lend Invest need retail investors' money? I would take a shot in the future that Lend Invest will probably not need retail money at all, because I would imagine that's a very small percentage of the type of lines that they have from institutions. So this may be sort of the end of an era. Again, it's nothing I know for sure. This is just my opinion. If we look at what's happened with the other companies like Rate Setter, Funding Circle, everybody that went institutional, they just didn't need retail money anymore because it was too small of a percentage of their entire group of funds that they had access to. And I just foresee that Lend Invest will probably end up going the same way. So if that's something you want to invest in, get in there now, because I don't know how much longer retail investment will be around for. Could be forever, could not. Moving on, Crowd Property has been named one of the UK's 100 fastest growing companies, winning a spot on the Sunday Times 100. It's a pretty big deal. Crowd Property is a homegrown business. They're not huge, and they managed to score a spot on that Sunday Times fastest growing companies at number 93. The paper said the criteria for selection was higher than ever this year. The number 100 slot went to a fashion company which has recorded sales growth of 49.9% a year, 7 percentage points higher than the minimum required to achieve a place on the 2022 table. And Crowd Property was one of just a handful of fintech-related companies to make the list. So congratulations to Crowd Property. Again, as much as I talk about some of the negative things about the administrations that we're going through within peer-to-peer, there are some really, really, really bright spots within peer-to-peer. And I think, the rest of 2023 and following 2024 is going to be a really strong year for fintech in general and peer-to-peer lending. Could be a little bright icon light in the stormy economic turmoil that we still see is going on. So good job, Crowd Property. Good job, peer-to-peer lending. Okay, this I talk a lot about what I think is going on with the economy, how I feel that we are in for some rough times. I feel like we're on sort of a house of cards on some sand when it comes to just debt levels, all this borrowing. There's an interesting story here. Borrowing falls as consumers raid savings. Right? This is a big deal. This really sort of paints the picture of where we're heading. According to the latest Bank of England money and credit statistics, net borrowing on consumer credit by individuals decreased from 1.5 billion to 1.1 billion in May. That's a huge drop. So they're not borrowing as much. However, households withdrew a record £4.6 billion from their banks and building societies. The combined net flow of both household deposits with banks and building societies and national savings and investments accounts minus $3.8 billion last month, which the Bank of England said was a significant fall from $5.3 billion in April. Economists and financial analysts noted that consumer borrowing and savings trends paint a worrying picture of the nation's finances amidst a prolonged period of high inflation, high energy prices, and the rising cost of household goods. Today's money and credit statistics from the Bank of England reveal that UK household deposits and savings fell by £4.6 billion in May, as customers likely used savings to stretch their finances and cover rising costs. That really tells you a lot about what is going on. It's a really sad state of affair. When I was in England, I noticed how much more expensive things have become. Energy bills obviously have gone up a lot. Rent is going up. Now with these interest increases, people who are coming to the end of fixed rate mortgage loans really, really going to feel the punch. And this is where I think we see those dark economic clouds coming in, sort of where things are coming home to roost. These interest rate increases are good for investors. They're good for people that want to have income from savings account interest rates. But for people that have mortgage loans, maybe even buy-to-let landlords, they're going to really feel the pain of these interest rate increases. And then administrations are not always just strictly for the UK when it comes to peer-to-peer. We had a filing of a bankruptcy in an American peer-to-peer lending company called Peer Street, which has been going for 10 years. I was actually really surprised to hear about this, but it happened. The property peer-to-peer lender said it is aiming to sell substantially all of its assets, including its mortgage loan assets and tech platform, to maximize the value for its shareholders. The company has said that it owes between £39.6 million and sort of £80 million to between 100 and 199 creditors. All but two of the company's largest unsecured creditors are retail investors, with claims ranging from $726,000 to $33.9 million each. That is a painful one. Somebody has an investment of $33.9 million. They are not going to be happy to see this bankruptcy. So unfortunately, these things happen. U.S. peer-to-peer lending is very much different from the U.K. I don't think it's really as widely covered here. So, it's just, unfortunately, that gladiator fell, and we're going to lose Peer Street in the U.S. I did also look at Peer Street. It was very interesting that they don't really mention anything about their bankruptcy on their website, which is just crazy to me. Not even on their blog, which they've not updated since November 3rd, 2022. Brits believe they lack the knowledge to invest. This is a disturbing article, because I'm trying to educate people on investing. It's not that hard, people. You literally can do it with just one investment, an index tracker. I talk about this all the time. But still, we just see these articles coming out saying Brits believe they lack the knowledge to invest. How is this possible in 2023 with all of the information out there? I guess the problem is there's just too much information. There's too much saturation. People read things and they don't know if it's true or not. Maybe they listen to people like me and think, this guy doesn't know what he's talking about. And then they get too scared and they just end up doing nothing. And I've been there because it's the way I used to be. I know what it's like. You just have so much fear that you're going to make a mistake that's going to be financially detrimental or very damaging. So you just end up doing nothing. Going to a financial advisor may end up being a really bad choice too. So I get why these types of articles are coming out. It just really disappoints me that in this day and age that we still have people that just don't have the knowledge to invest. 70% of Brits think they lack the knowledge to invest, with many fearing that they may become a victim of a scam. The study from the digital investment service Wealthify surveyed Brits who have at least £5,000 in cash and savings but haven't invested before. And I think these people are probably the ones that actually really need to invest the most, because they're the ones that have a little bit of cash, but you're not going to get ahead if you just keep all of your cash in a savings account getting 4% or less for the rest of your life. It's going to be very hard. So those are the people that kind of need to be learning about investment. Over half, so 50% of people surveyed said they haven't considered investing in the past year. 3 in 10 state they don't feel confident investing because of the lack of education on investment in school. I kind of have mixed feelings about this. This is something I've always thought about. What are the two things in life that we are least educated upon? That would be number one, relationships. How to stay in relationships with significant others without cocking it up and getting divorced. Number two, finances. How do you invest money? I think there's a reason why schools don't teach this. Number one, maybe they're afraid of the liability that they start having an investment class and old Joey McIntyre goes and puts his entire piggy banks of savings in some crazy tech stock that ends up going to zero. Or Norseman Gold like I did. And maybe he comes back and then sues the school. Who knows? However, I think a general investment education class in schools is desperately needed, and obviously this survey is saying the same thing. 1 in 3 people don't have confidence because of the lack of education on investments in school. Well, let's face it, if we were taught about investing in school at that young age, would we listen? Probably not. We're more interested in lunchtime or chatting to young Rachel across on the other side of the classroom. So whether kids would actually pay attention in school to an investing class, they probably wouldn't be interested. When you're young, you don't ever think you're going to get older, and you don't think you need to do stuff like that. But it couldn't hurt for sure. A common misconception was that the survey found the average amount of money that people thought they needed to have to start investing is £41,354. It's a very specific number. Where do they come up with that amount? £41,354. You see, people, if you are thinking about investing, you don't need the £41,354. You just need probably £1. In fact, you can go to a place like Trading 212, deposit £1 and get a stock worth up to £100 for free. So you can actually really get started for free. There's no excuse. Just go do it. Okay? Over the long run, you'll be fine. But yeah, that's pretty sad to still read that. Investor confidence grows despite inflation worries. So this is on the other side of the coin. We have UK investors that are experienced or have invested before. They're saying that 29% of respondents thought they were confident that investments are going to do well this year, up from 23% in the first quarter, or 42% was somewhat confident. Investors' portfolios remain relatively unchanged. This was a study Easy Money did. Mostly stocks and shares are still the most popular asset class, followed by ISA and bonds. The current level of inflation topped the table investors' concerns, along with rising interest rates and the cost of living crisis. Despite these worries, 40% of respondents are planning to invest more over the year ahead, which is up by 11% at the start of the year. It was pretty interesting. I got an email this week saying to me, why do I always poo on the FTSE 100 versus everything else? The FTSE's been doing great. So I had to just take a look at the chart because, that's what I do. And put things into perspective for anybody that thinks the FTSE 100 is the bee's knees when it comes to investing. Let's take a quick look at the chart. This is the 1 year chart. Obviously, it's always good to zoom out much further. We look at the FTSE 100. This is the blue line right here, the light blue. If you can see right here is kind of falling behind everybody again at minus 2.3%. That's a 1 year view. And if we look at the, I think this is the NASDAQ, which has been the darling recently with the tech stock boom, up 30%. And then the S&P 500 here in the black, which did dip below the FTSE at one time, but is now, we are in the black, 14.97%. We can even look at just a 3-month view here. And I know my head is blocking the view, but it's actually minus 5%, whereas the S&P is up 7.9%. And then if we take a look at 5 year, right, we can see our little FTSE down here has just really struggled. Minus 4% for the last 5 years, while S&P up almost 60% and NASDAQ up 77.9%. Of course, if you're able to nail the bottoms of these indexes, of course you're going to do well, but who knows how to do that? I certainly don't. See if you could get in down here in 2022, great. You're going to do well. You're going to hit a nice upswing, but I certainly don't have the skills to be able to nail those types of lows, and I don't think your average person is. So to the person that emailed me, I won't say your name, but just take a look at those charts and zoom out. And you can really see, how the FTSE has really fed. I mean, if we zoom out the max that we can, you just see down here in the blue that the FTSE is always just kind of lagging behind, which is always the reason why I've kind of said either do a U.S. tracker or a global tracker, because it just always seems to have done well. But some people are really stuck on only wanting to do the UK FTSE because they are very patriotic and that's what they understand. But it's generally not been the best place to put your money return-wise in an index. And, I've always think the indexes are just really simple ways to avoid, as my friend says, financial agitation, which I've been experiencing myself. Financial agitation is just not knowing what to do with your money. Like I'm experiencing it right now. If we take a look at the Trading 212 account, you log in real quick here. I've been having a lot of financial agitation with this account. Normally, when you invest in trackers, you don't have to worry about anything, right? You could just put your money in and just forget about it. But when you have cash balances like I do here with 6,600, which I'm going to have to do something with, I'm very hesitant to make some decisions with this portfolio at the moment. By the way, the portfolio is up to 17,751 pounds. We've had a bit of a rebound. I'll just run through the portfolio really quick so you can see what's happened. The big star of the show, we had a bit of a blunder here with this Canadian Overseas Petroleum, which has performed horribly. I'm down 60%. Glad I didn't put too much in there. Deutsche Bank is down 18% still. Flex, the natural gas, 17%. We have a small balance. But look at this, the star of the show right here, our darling Calera, is now up 63.35%. I was very close to selling this because I got emotional and thought, I've made another mistake and let's just exit it and get rid of it and take a tax write-off. And I'm glad I didn't. This is a really good lesson in being patient, just sticking with what your original theory is on something, right? So the original theory that I had on this company was good. Average price we paid for this is $3.81. And we are currently at 6.69. Now, this has been a really big swing on this stock because you can see we bought down here at, let's see if I had the price, 381, which was here. So you can see right there. It's probably back in September-ish. And then I watched this thing just go into the poo hole of $2. This thing went down. I think it went less than that at one point. And I thought, oh God, I've done it again, made a bad decision. But then we saw this spike, right? Back up to 5, and then boom, back down again. And then there's just this roller coaster. And then right down here, I watched this stock. I don't know why you're not moving, but I watched the stock go all the way down to 160. And I thought, oh, this is done. And then we get this takeover news for Calera, and the stock just absolutely wallops from right here at $4, smashes through, now 671. Today we're up about 1.2%. So lucky one there. The takeover news came out, said here that an Indian company has agreed to buy Calera. Now, this hasn't happened yet, so there's always a risk that this takeover just falls apart. But they agreed to buy it for 7.25, so $7.25 a share, which is, this is why I went into Calera. I thought it was really undervalued at $3, and then so did the Indian people too, who agreed to pay $7 for it. So even if we hang on and hope this deal goes through, which I think it does. No financial advice, of course, but that was a lucky one for the portfolio because it was the one that I had the highest balance of shares in. But that could have easily been reversed where I had a high balance in Canadian Overseas Petroleum and got this completely wrong. But this is the type of agitation that I talk about when it comes to investing and how difficult it is trying to pick out these stocks. It gives me a ton of anxiety. I really don't like doing it. I do it for the entertainment for the channel and try to make some money to give away to charity, but it's very, very stressful. But we did hit what I think is a home run, a 63% rise. And remember, we were down 50% on top of that. So we've come from minus 50% down to almost 64% up. That's a hell of a swing. These oil stocks have not really been performing, but I still stick by the case that I think oil is going to continue to do well. We've got the Saudi OPEC saying they are going to cut production to 9 million barrels a day, and this is an OPEC extended cut into 2024. We still got the problems with what's going on in Russia, so we'll see if that ends up playing out. I may just continue adding to these oil positions. I really need to take a look at this in depth over the next couple of weeks and put this 6,000 to work, because it's not really doing us any favors just sitting there in cash getting no interest, doing nothing. Interest rates too, by the way. If you're looking now, look at rates. I mean, Ford Money is now offering 4.25% variable rate on a flexible interest rate account, so you can get some pretty good interest rates. Personally, the fixed ones I'm not so keen on for 1 year. If this will change, which it doesn't look like it wants to, but you can get about a 5.6 on a fixed. If you want to go with Al Ryan Bank, me not so much, but that's just personal preference. You get a 5.8% on a 1 year fixed. If you on a 5.8 on a 1 year. I personally wouldn't do that because I think the interest rate's going to go up again, and I think you're going to probably be able to get close to 5% on a liquid easy access account. So I just don't really see much point in taking on a 1 year fixed at 5.8%. 5.7% now at this point, but rates are going up. So good news for savers. Probably bad news in some ways for some peer-to-peer companies who may going to really have a struggle to compete against savings accounts if rates do go up to 5%. Everything is just going to become more expensive for borrowers too. They're going to have to pay higher interest. Peer-to-peer companies are going to try to figure out how to pay you as an investor more money to make their products more attractive. So yeah, that Copal is going to zero. I don't know if the Copal is going to zero. I'm not sure. It could definitely go to zero, but it could also do the same thing Calera did. How long have we been going for? 52 minutes. Probably going to get out of here in a minute. Peerberry, is Peerberry any good? I'll be honest, I don't know. I've not really looked into them, so I don't have any energy on Peerberry. But I do hear actually a lot about them. Let me take a quick look at their website. Peerberry. Oh, this is a European platform. Yeah. Up to 12.5%. Let's look at the statistics. 1.8. Is that billion total invested? No, right? Is that? Outstanding portfolio. 115 million euros. Definitely it seems some growth along the way. You know, the problem with European companies is I don't understand regulation out there. Not that regulation is the be-all and end-all, but I do think you are taking on some additional risk. Look, if you're UK-based, I mean, obviously if you're a European EU citizen, it makes more sense, but I think that Europe is kind of a little bit more of a Wild West when it comes to this type of alternative lending. Not to say it's bad. I'm sure there are some good companies out there, I believe, who are doing it. I just don't understand it like I do the UK market, so I tend not to pay as much attention to it. But, you know, I always say if you want to try something, put in a little bit of money and test it out. Give it 6 months or a year and then dip your toe in a little bit more. Look at this. Obligations of war effective loans. 23 million euros. Yeah, I mean, you've got some of these Russian peer-to-peer companies too the European peer-to-peer companies that invested in Russian loans, and now look what has happened with that. So it's a tricky situation for sure. Is it worth selling Claire and taking profit? Oh, absolutely. If you're a sane person, you'd probably say, what is the max upside? I think the max upside is probably somewhere from where we are now up to $10 a share, but it also, if this deal falls through, it could possibly go lower. That would be the smart thing to do. I'm a gambler when it comes to this portfolio, so I'm probably just going to hang on to it till the announcement that the acquisition is done, and then, like, you get the benefits of that. But for a conservative, sane person, I'd just probably take the money and run now at this point. Death Spiral. Oh, goodness. We'll see. We will see. Chimpo Naughty is here. Hello, Mr. Chimp. Anyway, if you could hit that thumbs up and subscribe to the channel if you're not already subscribed, I appreciate it. We'll be back next Wednesday. Keep an eye on the YouTube channel because I'm going to be releasing a couple of new videos, and go to the website. I got a new article coming out soon about what was my biggest financial blunder of 2022. It's a really, really painful one to show that I'm still human. Like everybody else, I make blunders, and I made a pretty nasty one in 2022. So you can go and read about that and hopefully not make the same mistake that I did. But I appreciate every single one of you, from myself and a very sleepy Holly pup. We will see you next Wednesday, same time at 7:30 p.m. UK time. It's 2:30 p.m. Eastern American Yankee time. Yeah, that's all I got for you. I'll see you next time. Take care. Bye.